Charles Harris here, the life insurance guy. Let me ask you a question. How does your money grow for you? How do you grow your money? Well, money grows three ways. It grows fixed, it grows variable, and it grows indexed. And most people are familiar with fixed and a variable, but they've never heard of indexed. And fixed would be like a bank account. It's a set amount that you get, and usually it's a lower amount with fixed accounts like banks and CDs and bonds and things like that. Usually it's at 1%, 2%, 3%, something like that. The problem is inflation now is growing, 2 to 3% or more. We just don't know what it's going to even be like in the future. So it's growing as well. And your fixed amount, is probably growing or not even at what inflation is growing. So you're actually losing money in a fixed account typically, or just by not even having your money in any account, just by it, sitting in a safe or wherever it's sitting. Variable accounts would be like the stock market. It'd be like your money, having your money in stocks, in a 401k, something that's tied to the stock market. While there's that chance of a lot of growth from the stock market, there's also the chance of the loss, and your money is at risk. Your money is at exposure because you don't know how the stock market is going to perform. No one knows that. So there's that potential. And then also one of the things is what you've lost more than anything in an account like that is when you take a loss, you actually lose the time. Because think about it. Let's say you had $1 million in an account, and let's just say the market was down 50%, your money would be at $500,000, right? But if it was up next year 50%, your money wouldn't go back to 100,000. It would only go to 75. And that's the problem right there. It's the time you've lost. Now with the index strategy is contractually guaranteed to never lose money at all. It's always 100% principal protection. There's a zero floor on the money, or on this type of account. So on years when the stock market is down, insurance companies do not exercise the option. So if you had $100,000 in an account and it's tied to the S&P 500, and the S&P 500 is down 10% for the year, your money is still going to stay at that 100,000. Whereas in a different type of account, if that money was tied into, if it was in a 401k or a stock or something like that, and that index or that stock or that the S&P, whatever it was tied to, was down 10%, you would be at 90,000. With the index, you stay. You're only participating in the market on the years when there's growth in the market. So that's is the power of that. But the biggest thing to know is that you have this option. You don't always have to take a loss. You don't have to take a loss in a fixed account. You don't have to take a loss in a variable type products. You do have options. Index is an option. It's just not an option we've never been taught. So because of that, it's important for us to understand these options and understand how to play in this game of money. So that is, one of the fundamental steps in creating wealth is being able to identify these options of how your money can grow for you and work for you. So those are the three ways that your money grows. And with that, until next time, peace and blessings.